Okay, how did you spend your summer so far? Well, Charles Ortel of Newport Value Partners, he's been studying the balance sheets of almost 24 Dow Jones Industrial stocks. His conclusion that big, what he calls legacy companies, they operate from disadvantages. Let's find out exactly what that means. Charles, good to have you with us. Thank you very much for doing all that balance sheet work. What do you mean by this legacy companies operate from disadvantages?
Well, in the old financial world, the one that I think ended on September 13th, 14th, the theory used to be that if you were an established company with strong customer positions and factories and good workforce relations, that stood you in good stead. Now, I think what we're seeing is that these companies that have operated for years have built up unfunded pension liabilities, environmental liabilities, potential workforce issues, and find themselves rooted to the older economy, the large advanced economies, and hostage, in our view, to political interference that we've seen on an unbelievable basis since the 13th, 14th, to being...
What happened on the 13th and 14th that makes you sort of mark the calendar red on those days, September 13th, 14th?
In my view, that's when the free market basically failed. You know, we had a deal before then that if you were on the board of directors in a senior management position of a company and you ran into a wall, that's it. You know, you didn't get a second chance. You didn't get the ability to get a big blank check from the government and then modestly tamper with the management, maybe keep the same directors in place and move on. On the 13th, 14th, all of those rules of the game went out the window. One firm, Lehman, was grievously rent asunder. But we're still living with the AIGs, the Citibanks, the Bank of Americas, and we have the specter of, you know, if you get into disastrous trouble, the only people who seem to be footing the bill are the taxpayers.
Well, but wait, I mean, we can say, though, that one of the people that might be footing the bill, or at least coming to the rescue, is Warren Buffett in the guise of Berkshire Hathaway, right? Because, I mean, he has been known to step in and take large positions in companies that are in dire straits, right? I mean, GE was one of the companies, and I know that you've noted that in the past. Is there something about what Warren Buffett does at Berkshire Hathaway that we ought to take special note of? Is that going to mean that he's got to change his portfolio as well?
Well, I think with regard to Mr. Buffett, I mean, he put together some legendary, very astute investments where basically you invest in Berkshire Hathaway and you get the chance to play along with Warren Buffett and share in deals that the ordinary human doesn't get. And that's an important portion of his portfolio. But in addition to that, and where we take issue with him, we think he's spread too thin in too many less interesting areas in smaller industrial and services companies, which we just don't see the merit of. And then also in this area of derivatives and trying to bet against the world, which we think is, off kilter from his core strategy.
So what should he do? Should he concentrate more on what the insurance business is all about? I mean, isn't that really the core? Berkshire Hathaway is the insurance?
It has historically been the core. It's been his source of, of capital for most of these investments. The insurance business is a tough business, particularly if you have a dim view of the geopolitical threat situation, which I do. But I think, he has enamored himself and put himself in a preferred position where if a company that fits his footprint, that in theory is simple to understand, he has a checklist of different things, becomes available, he's obviously one of your first calls. I would be concentrating on 6, 8, 10, 12 of those. I'd be thinking about divesting myself of maybe the whole group of his industrial and service operations.
But he says, but isn't that part of the whole ethos of Warren Buffett and Berkshire Hathaway is he never disposes of a holding? In other words, that's part of the criteria when he goes in to make an investment. He talked about it, I think, when he looked at something like the Buffalo News, the newspaper.
Right.
He doesn't look to exit these positions. Maybe he's not, because they don't move the needle that much anyway. So what would be gained if he diversified away?
Well, that's again where I, with great respect, take issue with him. I think the world from 1965 to 1999 was one place with strong tailwinds, and that from 1999 forward, we've been facing massive headwinds. So I think it would be a good idea for Mr. Buffett to consider adjusting some of the game plans that worked so well in that period, 65 to 99. His track record was exemplary in that period, but from 99 forward, it actually is not really that good. And so I think, again, with great respect, he should think about changing some of those core tenets.
What would be one of the things you'd like to see him change? I mean, would you like to see the company start to pay dividends, for example?
Well, I'm less. It really depends on the tax efficiency of that, and I think that's not all that tax efficient at the moment. But I think that, and he said it himself, with a vast pile of assets that he has to control and a fairly limited span of control, you can't devote the same attention to every piece that he was able to do when he was smaller. It's very tough to replicate the returns that he got on a smaller pile of assets. So why not move the needle a little bit? Why not maybe consider dividending out this collection of industrial and service companies, maybe levering up but dividending out?
What, it's splitting the company into a financial service business, which would include insurance, and then moving the industrial and those non-financial service industries into another separate holding.
Right. Why not have more concentrated strategic bets? My issue with GE, I have other separate issues on just the basic...
I know, you got a lot of issues with GE. That's we know. But
in terms of the size of that investment, for Mr. Buffett, it was a relatively small thing. I'd prefer to see him, thinking in terms of, 7.5%, 10% of a portfolio going into one of these strategic bets for the long term. The model of getting preferred with a fat dividend and warrants is a nice one. And looking ahead, we see trouble coming after Labor Day. We think we're in for another round of tough relooking at balance sheets and companies around the world. And out of that trouble, a firm like Mr. Buffett's will be able to make very interesting investments, we think, going forward, if he's not distracted with these other smaller industrial.
But he's got a big cash pile, right? I mean, he's got enough cash to go out and deploy it if he needs to.
Right, but I think if he rejiggered things around, he could scare up even more cash.
Okay, all right. Well, I want to thank you very much, Charles Nortel, coming in from Newport Value Partners, sharing your insight and your work on taking a look at Berkshire Hathaway. Appreciate it. Thanks very much.